Welcome back. You're watching The Money Show with me, Kavita Thaplayal. If you are someone who did not participate in the market rally and are now dealing with FOMO or fear of missing out, then worry not. On The Money Show, we have got your back. We will tell you how you can start investing in the current market and what should be your investment strategy and a lot more. So let's welcome on board Kaustubh Belapurkar, Director Fund Research, Morningstar Investment Advisor India. Kaustubh, good evening and welcome to the show. So can one really invest during these times of market high?
Hi, Kavita, and thanks for having me. And I think it's a very pertinent topic that you've raised, obviously, because we've seen the markets making new highs recently, and investors are wondering if they've been waiting on the sidelines what to do, right? And there's often that conundrum that do I wait? Do I wait for a correction? Do I invest all of it right now? So let me address that in two bits, and let me share some interesting insights that we ran through two studies, which will throw some light about just the way the market as an animal works in terms of returns, right? So the first one, essentially what it did was we looked at the past 10-year returns of the index. So take any broad index, the Nifty or the Sensex, and similar results would also follow for some of the other mid cap and small cap indices. But essentially what we did was we looked at the monthly series of returns for the index and compared that versus cash equivalent, which in this case was liquid fund returns, right? We put it in a sort of best to worst case scenario. So the best months on top and, in a descending order of returns on a monthly time series. What the data showed us is that 11 months out of the 120 months over the last 10 years accounted for the entire outperformance of the market versus cash, right? So if you as an investor were not invested in the markets in those 11 good months, as we call them, you would have actually underperformed even just holding a liquid fund, right? So which is staggering. So 11% is even less than 10% of the time frame. And you can break it up into weeks or days. You will get similar sort of observations where a very limited amount of days or weeks or months account for the entire outperformance of the market versus something as something as simple as cash, right? So I think that's a very important lesson. Why? Because these time periods can come at any point of time, right? So you have to be invested in the market. What we call as time in the market is more important than timing the market. I think this is a very interesting case in point that shows that. Right? So I think that's one key takeaway for investors who are probably sitting on the sidelines wondering, has the market run up too much? Should I wait for it to fall? Here's a case study that, you can't really time the market. What's important is to stay invested in the market for a longer period of time, right? That's one. I think the other interesting study, and we talk about that equity is a great asset class, no doubt, but it comes with the baggage of volatility, short-term volatility. So how do we really make or ride the volatility, right? The right investing time horizon. So the other study that we did was we looked at the rolling returns of, again, the Nifty and the Sensex, over the last 20, 30 years. And essentially what we did is this was like a daily rolling, and we did it over different time frames. So let me just explain what that study told us. If you held as an investor, you came with only a 1 year investing horizon and you invested in these funds on the indices, on an average, you would have made maybe about 13.5% over the last 30 years on a 1 year rolling. But the range of returns was very broad, right? So on some lucky day, you could have made 100% plus returns, if you were entered on that one lucky day. But there were also times where the 1 year return negative 55%, right? So the market fell, more than half your portfolio value was wiped out if you came only with a 1 year investing horizon. 30, the market was actually negative over a 1 year horizon, right? So when we say that, you have to be in the long term, this is really one, example which tells you that very short termism can actually hamper your portfolio. But as we extend this time horizon, so when we look at 3 years, we look at 5 years, extend that to 7 and 10 years, two things happen. One is the probability of negative returns, or the percentage of negative returns observed during this time period shrinks quite significantly. So
Okay, I think there's some technical issue with that, and we just lost Kaustubh there. But then to the time we get him back, very important things that Kaustubh also was trying to highlight is that timing in the market rather than time the market should be the focus for an investor. I think I have Kaustubh back with me. Kaustubh, you want to continue?
Yes, Kavita, thanks so much. And apologies for that. So the point that I was making is that when you look at extending your time horizon, and the example that I was giving was if you're invested only with a 1 or 3 year time horizon, the number of observations that we noticed on the index, which were negative. So for 1 year, 1/3 of the time, had you only come with a 1 year horizon, you would have actually lost money, negative returns, right? But as you extend your time horizon, you go to 5 years, 7 years, 10 years, the probability of making returns and positive returns grows up significantly. The predictability of returns goes up, and that's what the historical data showed us. So the other tenet of staying invested with the right time horizon becomes very, very important for investors, and even more so in these times, right? When we are seeing new levels of the market, I think it's very, very important that investors come with the right time horizon. I think that's the first very important lesson, that always think about long-term with equities. Do not come with, looking at the past returns and expect the same returns over a very short time frame. I think that's the first thing. The second one, and I think, which was also being spoken about by the earlier panelists, was about asset allocation. I think that's very, very key. Every investor will have different requirements, different time horizons, and asset allocation should be followed at every point of time, not get too greedy or too conservative. I think, the right mix of asset classes is very, very important when you think about investing in the markets. Invest regularly. We all talk about SIPs, and I think I cannot stress more about in times like this. Do not, even if you have all the money available today, do not go all into the market, especially at these levels that we're seeing today. Invest, stagger your investments over, at least the next 6-12 months. And obviously, if you have a recurring SIP that's running over years, that's great, because I think investing regularly can really reap the benefits of avoiding that market timing risk that comes in in a volatile asset class such as equities. So I think if you keep these few simple things in mind as an investor, let's forget about where the market level's at. We don't know where it's going to be tomorrow, where it's going to be 6 months or 1 year down the line. No one can predict it. But you come with the right time horizon, 7-10 years,
Right. Right. So exactly. So rightly, as you were pointing out, that one needs to have realistic expectations. So we've lost Kaustubh again, but then once I get him back, we really would want to know as to Kaustubh. So the question that I was asking you was, so it's right that one needs to have a longer term strategy and one needs to invest continuously in a disciplined way so that you participate at all market movements and levels. But then right now, how should we be staggering our investment? Should it be via SIP route or even a lump sum if we try to do at different intervals? We will get the benefit of averaging in the longer term.
So I would definitely, even if you have all your money available today, I would still recommend staggering it, over the next maybe 6 to 12 months at least. And obviously, if you're running a recurring SIP, for longer years, that's great. But I would definitely not think about putting all the money at one shot right now. I mean, just given the vagaries of the market that we've seen, I would definitely recommend staggering it over the next 12 months, just to be, even in terms of peace of mind, because behaviorally investors tend to behave very differently. If you put all your money today and the market corrects, 15, 20% for whatever reason, they can behaviorally start pulling out money. So I think SIPs also kind of protect you against behavioral biases that all of us are kind of susceptible to.
All right, so that was all about making the most of the market movement right now. And with that, Kaustubh, let's move on to our viewer queries also. I have Neeraj Verma on the phone line with me. Neeraj, good evening. How are you doing?
I'm doing fine, thank you.
From?
I'm from Assam, Neeraj Verma.
Okay. Neeraj, I think you want to start your investment strategies. I mean, in your mutual fund, you want to start investing by 5,000 per month for a period of 3 to 4 years. Is that it?
Yeah, that's right.
Okay. Any specific corpus that you want to accumulate in 3 to 4 years?
I mean, anyone can give me a suggestion. That's what I need.
Have you invested?
Because I've just sort of finished a 4-year investment which I have encashed, just been redeemed. So I just want to start a new one.
Okay.
I had Tata Global, which I have redeemed.
Okay. All right.
Which one will be useful? And I'm a senior citizen, just to inform you. So my time I've said 3 to 4 years.
3 to 4 years, and I believe the risk profile is also not very aggressive. And 3 to 4 years, any which ways, I don't think so. We can suggest you a very aggressive strategy over here. Kaustubh,
Right.
what is
Right.
your take?
Yeah, so I think given the time horizon, and like I was alluding to in my earlier sort of response, that uh, especially for volatile asset classes, you need a longer time horizon. And what I would suggest to Neeraj is, given that he has a 3-4 year time horizon, I would, I look to allocate a bulk of the money or the investment into, sort of fixed income funds, clearly with the mandate of not really losing capital, but getting a more steady, sort of less volatile experience as a part of the portfolio. If he's amenable to taking on a little bit of volatility risk in his portfolio, perhaps up to about 15-20% in equities through index funds. Again, the reason why I'm, harping on index funds, given that it's a limited 3-4 year horizon, you typically want to take it through large caps and, not be susceptible to style drifts or, kind of style cyclicality. So, just buy an index fund. That'll just be the easiest way of doing it. And your fixed income allocation, which is about 80-85%, typically you would want to do it through some short duration funds, which would probably be an ideal way of, with no credit risk, getting into some of those strategies.
All right. Neeraj, do you want to ask anything else?
No, I was mainly interested in this. I'm an advisor in a tea factory, so I'm out at work. So this is what I was wanting to start a mutual fund, because I've just redeemed one after 4.5 years.
All right.
And I gained well, so I want to, because I have investment in shares also.
Mm-hmm.
So I just wanted to 3 to 4 years. It could be 5 years also.
Okay. All right, Neeraj, thank you so much and all the best. We have to move on, and I have Avinash with me now. Avinash, hi. Okay, I think we just lost him, but then let's take up his question. Kaustubh, he wants to start an SIP of 50,000 per month with a time horizon of 20 years, and he wants you to suggest at least 10 mutual funds, and out of which in 5 to 6 he says that he'll be investing, and he also wants a foreign equity component in his investment portfolio.
So it's great that firstly that Avinash has this long time horizon of 20 years, and what I would recommend is obviously to start, especially if this is money that he doesn't envisage really touching upon for the next 20 years. We can largely go into an equity sort of portfolio for him, maybe keep 5% in ultra short liquids for emergency purposes, but I think the remaining can easily, given the time horizon, go into equity funds. What I would recommend is essentially building a mix between large, mid, and small, and I would think, given the extended time horizon, and if he's okay to take some risk, I don't know what his risk profile is, but we can add about 35% in mid and small caps, and the remaining into large caps, and this can be done through a mix of funds, right? So you can either do a mix of large, mid, and small, or you can add some flexi cap funds to achieve the desired allocation. And obviously, there's a whole host of funds that we like amongst all this space. So in the large cap, you have the ICICI Blue Chip, your Mirae Large Cap, the Birla Frontline, and if he wants to keep it simple, he can even just get into an index fund. Flexi cap, obviously, there's the HDFC Flexi Cap, the Parag Parikh Flexi Cap, the Kotak Flexi Cap, and similarly on the mid small cap side. The other thing that I think what's important for Avinash to think about, and like he rightly said, some global allocation. So one way is obviously, the Parag Parikh fund, and that's one of the reasons also, why it's different, is it also has an element of global allocation portfolio. So you can achieve, global allocation through this fund, or you can, potentially get into a NASDAQ sort of ETF, which will give you exposure to the largest sort of market, across the world. Also, what we're recommending through the funds that we've selected is give a good blend or a style diversification. Again, very, very important. I assume Avinash is probably investing for the first time. So it's important to think about style diversification where you're adding growth, blend and value style funds within the portfolio. And that's what we've tried to do by some of these funds that, kind of blend well together, so that some portion of your portfolio is always working for you at different points of time. I think that's something that Avinash should keep in mind, when he's picking amongst these funds that we recommend.
All right, next question comes from Shilpa, and Shilpa has SBI Equity Hybrid Fund. She's in a lump sum investment out there, SBI Balance Advantage, SBI Equity Fund, Axis Small Cap, ICICI Prudential Technology, and the goal is 2 crores in 15 years. She has an SIP, a mix of SIP and lump sum in her portfolio.
Yeah. So I think some very quick thoughts on what Shilpa really needs to do with the portfolio. Firstly, I see too much risk in the portfolio. I mean, despite the fact that obviously she's gotten a 15-year horizon, which is great. But two things, right? So one is when I just look at the SIP amounts of 5,000, 5,000, 5,000, there's about 1/3 of that going to a small cap fund. I think that's quite risky. We want to bring that down to about 15% of the portfolio. Whatever said and done, large and mid cap should be your integral part of your portfolio. That's one change that you should definitely look to make. The second thing, and more importantly, she's got 1/3 of that going to a technology fund. Now, any sector, right, should only be a peripheral part of your portfolio if you can take a call on the sector. Right now it's about 33% of her portfolio. That is staggering. When you think about technology as a sector, and no views on the sector that I'm trying to give, but this is essentially what we've seen in the recent times, right? So post-COVID 2020, 2021, we had this huge run-up in tech stocks. We all know that. But most of the money that came into these funds was after the run-up. And that traditionally happens with human biases looking at past returns. But remember, sector rotation is, it is a rule of the market. It happens all the time. We've seen that, and we know, tech has kind of, relatively underperformed as compared to the other sectors since the last year and a half. And I think that's very important to keep in mind. So if you're overexposing yourself to a sector fund, keep that very, very limited, and ideally only investors who can take a call on the sector or want to express a very specific view on that sector should be taking some graded exposure. Definitely not 1/3 of your portfolio. So I would recommend Shilpa to stop SIP in that and look to invest in more diversified equity funds, and in a similar fashion that we spoke about to the earlier investor, between large, mid, and smalls. And she can truly enjoy the benefits of the underweight and overweight calls that a fund manager will take, but it'll be much more graded as compared to going 0 or 1 in a particular sector, right? That's one. With regards to a goal, she's got a goal of about 2 crores in 15 years. I think she'll have to be aggressive with her investments in terms of ramping up the investment. So not aggressive in terms of her approach necessarily, but in terms of currently she's doing about a 15,000 rupee SIP monthly. She need to aggressively step it up by almost 20% every year to make sure that she's got enough corpus built over those 15 years. And secondly, we spoke about the timing risk that comes in with entry, but there's also timing risk that comes with exit. So you want to avoid that you have a goal 15 years down the line and you've come close to meeting it, but the market, you're invested fully in equity and it falls and your portfolio value falls well below your goal level. So you need to start thinking about not just planning how do you do asset allocation today, but how do you gradually move from equities to a less volatile asset class such as fixed income gradually over time as you start approaching your goal. Because if you plan that well, you can reach your goal comfortably, provided some of these measures that she takes, especially when it comes to reallocating the funds and stepping up the SIPs quite, smartly over the next, going ahead in the years.
I think with that, it's a wrap. Kaustav, thank you so much for being on the show and helping our viewers with their financial portfolio queries today.
My pleasure. Thank you.